Good. Welcome, everyone. Good evening. My name is George Ozoude. I'm here with my partner, Adebayo Fasanya, and we're going to be talking about our investment opportunity that's based in Houston, Texas tonight. This is the Ridley Apartments. It's 405 Class B units in the really prime area called the Galleria. And so we obviously always want to lead with this general disclaimer. Please consult with your financial, legal, tax professional. This is not an indication of guaranteed returns. We always like to lead with this disclaimer. Past performance is not an indicative measure of future performance. Same thing, financial disclaimer. And so with that out the way, first thing we always like to lead with is talking about the team. And Bio and I have been working together for many months and almost 2 years now. I will talk about myself, then I'll kick to him. But I am a founder and CEO of Time Health Capital. I'm also an orthopedic surgeon, as mentioned. I'm based out of Houston. I have my own private practice after 8 years of working in employed practice at the University of Texas. Started my own private solo practice. It's all direct cash pay, no insurances, no government interferences. It's my own baby. And I was able to start that journey by beginning my passive income journey to financial freedom by investing in real assets, mostly multifamily, like the deals we're presenting tonight. I started in 2016, started actually in the medical office building, venture capital, transitioned in 2018 to multifamily. Since then, I've gone on to invest in a total of 25 deals. Most of them are multifamily, value add and development, so a mix of both. I've allocated over 1.5 million into these assets. And I've gotten so passionate about it, and I understand the friction that other physicians are facing. So a year ago, I started my own syndication company because I didn't see a lot of physicians in the space, in this investing space when I was investing. And I think that's something we need to see more of. We need more financially free physicians who have career autonomy. That was something that compelled me to start my own practice and search for financial freedom. I just wanted to be a better doctor. And today I'm doing that. So I started Time Health Capital. And since starting, I've invested in, this will be my fourth syndication as a co-GP. This will be approximately 900 units and 75 million in assets under management. And so I'm really excited to continue this journey, spreading education and opportunities to invest with other physicians, other healthcare workers who are also feeling the same frictions that I felt. And so with that, I'll kick it to Bio.
Welcome, everyone. Dr. Fasanya. I'm a CEO for Dr. Ridley Capital. And also, I have my own private practice, Arkansas Lung Center. And I'm able to do that, same reason, because of autonomy. And also, I've been able to build a good nest egg of not only passive income, in my case, I call it semi-passive, or sometimes active, because I actually do operate deals, not just raise capital for deals. But either way, it allowed me the freedom. So not just capital, which allowed me for time and autonomy. I started off actually in my undergrad. So that was like 2008 during the crash. That was in Canada, Toronto, with my parents. We were doing reassignment homes. And then, during medical school, I took a break, right? Focus, pass my buds. And then during residency, I started investing as limited partner because I was moonlighting, making the extra cash, and every extra cash goes into syndication. In 2018, I finally got that bug of what I want my own properties. So I bought personal properties, and then I was being mentored by my mentor that basically showed me how to do real estate syndication, and I raised money for him for a few years, and then I started my own company. Since then, we've been involved in over 1,000 units in multifamily, but we're also diversified. I identified as a real estate syndicator, not a real estate syndicator, because we have done oil and gas deals. We've done 2 funds that we've raised money for. We've done luxury senior living. which we're actually exiting one of them. We also done a lot of self-storages, at least 5 self-storages so far. And one of them is actually in Houston, Pearland, which is just like outskirts of Houston. So that gave me the excuse to visit Houston in general, apart from visiting George. So we also involved in multiple businesses. At the core of it, I really believe that the fastest way to wealth, it may not be the safest, is basically investing in businesses, scaling it and selling the businesses. Also venture capital. I'm involved in over 20 startups. Don't ask me how many of those are successful, but I do like startups, and you have to risk accordingly. But the core, the base for me is multifamily. So that's what I consider like my bonds, which allow me to basically what I can fall on. So in terms of percentage wise, multifamily is by far the largest of my portfolio. So having said that, I'm very excited to present this opportunity. This is going to be our first one this year. So just to show that we're not just jumping on every deal. So we take our time, especially in this climate, before we decide to partner or sponsor a deal ourselves.
So just to quickly show you the rest of the team here, there's other folks that are involved. This is a team effort. So we have other capital groups that are involved, and you can take a look at their resumes here. Another one's also physicians. And then the lead sponsorship team is the Disrupt Equity team, Ferris Musa and Ben Suttles. These are two guys that I've known for, I want to say, 6 years now. 2018 is when I first met them. And I've invested with them not only as an LP, but as a co-GP. We actually did a deal last January. We closed on a 260 unit deal in the northwest corner of the inner Houston Loop, Jersey Village. So I say that to say this is a group who we have track record with, and they performed on both deals. On that first deal, I invested with them in 2019. That made 20% average annual return over 3 years hold. And the current deal that I'm invested with them as partner now, as a co-GP, it started making pro forma returns, meaning that it's hitting its projection, delivering 6.5% cash on cash return, delivered monthly. So they're distributing out monthly on a strong property. And I feel like the property that they have now is even better. I'm really excited to work with them again on this deal. It seems like a partnership that's going to continue to grow, and that's key. That's really key. I can't emphasize that enough. There's a lot of deals that are going to be coming on over the next 12 to 18 months. Just like Bio said, the last year or two has been slow just because of the macroeconomic headwinds. But now we're going to see a lot of deals coming online, a lot of discounted deals just by the nature of the interest rate hikes and old operators having to sell at a discount, which is the case in this deal. So I really emphasize on knowing how to vet a sponsorship team. Knowing that the team has a track record together is very important. It's the most important thing about the deal. So I'm really happy to partner with these guys again. You can take a look at their resumes and when we send this slide deck. Their experience runs deep. So they have a large portfolio holdings across multiple states in the Sunbelt market. It totals over $800 million in assets, 5,000 plus units, 19 properties owned. And again, 2 of those properties I've already been invested with as well, and they're both performing. So let's talk about this particular property. This is the Ridley, located in the Galleria, Houston. Bio, I'll kick it to you to go over some of these important numbers.
Yep, I love those numbers. So this one thing that stood out to me was the discounted basis that we're getting in this deal. So you make money when you buy, and this is even more important now because we are not going to sugarcoat it that in the past few years, there is a cash flow issue with multiple properties. And when the syndications are not performing according to pro forma, So I'm actually quite impressed with this team that they were still able to do that in this economy. However, what you want to happen is no matter what happened in the deal, you get out alive, right? So the best way I feel like to do that is to get that big discount from the jump, so that worst case scenario, when you sell, at least you get that, that percentage back. So you just make, at least the 25% back, right? So you make, so you at least make your money back. So that's first thing. So the prior ownership, right? They actually bought it at 88K per door. And then they put another $4 million, about 10K per door improvement into it. And now they're selling it at 66,000 per unit. Even if let's say they over bought it, if they basically paid a premium, so we are still getting it at a discount. When we did the comparables, including one that was literally just right next door, we're going to talk about that later. So that's about over 100K a unit, right? The one that was just sold. So it's actually more than 25K. It's almost 5% discount at this point.
Yeah, and I think one real key thing is the story behind this discount. The deal was purchased by another group that I actually know, and they bought it in 2018 during the hype of all the real estate multifamily boom. They used variable rate debt that went up after 2022 when the Fed raised interest rates. And that was the heavy headwind they faced, because now they could no longer pay their mortgage. Their loan went from somewhere in the 3%, the 5% range up to a 10% range. And so now they're losing money. They didn't have money to put back into the building itself. The occupancy started to drop. And the capital partner for that group actually had a clause that allowed them to remove the lead sponsor and take over and try to save the property. And that's where that almost $4 million of capital expenditures was put into the property to improve it. And Bio will show those improvements later on, and then bring the occupancy back up. They successfully did that over last year, and they tried to sell it. This is a capital group that does not do multifamily. They're a REIT, they're a real estate investment trust. And so their focus is on other sectors and other asset classes. And they're based in Canada. So they're really managing this thing from afar. And they really wanted to get out and try to at least get their money back. Two buyers tried to acquire this last year, and they just couldn't make it work at the higher price per door. So what happened is that REIT finally had to capitulate this year, meaning they had to sell at a discount. They'd rather get out of the property with taking this loss and move on to their main focus and main book of business. So that's the story. And the story is always key as to how they came to us and how it came to our table. And that's really compelling. We're really getting a valuable property at a discount because they had to capitulate.
Yep. And like George said a while ago, we're going to be seeing more of this.
Yep.
Just a lot of averages, right? And especially people that bought high recently, and also people with high available interest rate that were not able to fix their prices, that fix their interest rate. So
it's going to be a common story.
So another exciting thing for me was the financing. Before, we used to do a lot of local banks, and now we have reached a state in which the assets are big enough and has enough meat on them that we're getting agency loans now, also with track records, right? If you combine the track record of all the GPs, so it's easy to qualify for agency loans now. So this is big, because if you're going to go to the bank now, the lowest quote I got was 8.5%, and some quote 9.5, especially non-recourse, right, loan. This at below 6% interest rate is impressive. Just that alone, to me, I already know, based on just when someone sends you a deal, I just get a few things. You get financing is cheap, you get the occupancy rate, and then you get it. So you know that this one passed the sniff test. And you can see it's 7-year term, and the deal is for a 5-year hold. But we have that 7, obviously. If the market is still 10 years during that time, then we hold it longer, right? So the most important thing is not to capitulate like others did, right? It's for you to be able to push the deal till the very end. And having a very fixed rate, that's very important, right? Because everybody learned their lesson. We might think they're going to start dropping the interest rate, and they might change their mind, right? So what are you going to do? So, and that's really will kill so many deals. Another thing is that it's not highly leveraged. So it's only 63% loan to value. So which means we're only taking 63% from the bank. Yes, you could put less money down, make more returns, right? But then you have less cash flow. So it's all in the balance. But we just feel like at this point in time, it's just better this way.
Yeah. And I would also add, it's a time where there's a credit crunch. Banks aren't loaning, or they're loaning 50% loan to value, which also makes it, harder to make the deal work when you have to bring so much capital. So finding that right balance is key. And a lot of banks are actually pulling back. They're not lending. They're giving sub 50% loan to value. So this is very important.
Another thing is the part of the business plan, which we're going to talk about later. But the going in cap rates of over 7.5%, if you're in this business long enough, you understand that when the cap rate was compressed last year, and maybe a little bit of the year before, we were seeing people buying at a cap of 4, 5. That is such it's overpriced. So now getting something at 7.5 in Houston, I don't even care where in Houston at this point. It's very good in terms of when you're trying to sell, you're going to try to sell at a lower cap rate of maybe 6. So, and even if you are just selling at this cap, you at least make your money back. So my most important thing is just what is going to make sure that we get our money back in this deal. And the year 1 projected revenue, it's lower than the T12. So the T12 is actually already performing better right now. And we're going to even talk more about the fact that we've tried different deals. We tried construction, deep value add, light value add. So this particular deal is going to be a light value add, if anything. And so it does not really rely on that. So that makes it very exciting to me, because we all know contractors and also the price of renovation has gone up. So I'm very, when we did the underwriting, we actually went through and basically eliminated everything and say, you know what if we don't raise the rent at all? What if we don't do any value add? We just continue, continue the way we are. And then maybe year 3, we finally raise just a little. What happens? And yet we're still able to make some little profit, even with 80% occupancy. So, yeah, excited. So another thing to understand is, as many deals are going to be coming into the market, you have to understand whether the deal itself is in distress or it is a partnership, okay? So in this case, the asset itself is not distressed by nature. It's the team that are distressed. So then the next thing you need to do now is vet the team. Like, do you believe that this combination of teams will be better than the old team? So that's the only major decision that needs to be made. But if a property is still 90% occupied, despite all, has already done a lot of capex improvement, and it's well maintained, you've seen the pictures. I was asking Joy, I was like, is the pool functional? Yeah. So it's a very stable asset.
So I'd like to now switch gears and talk about the Galleria in Houston. I'm based Houston, so I'm boots on the ground here. I have other investment properties here. I was born in Houston, even though I grew up in New York City, and I've been back in Houston for my fellowship training and practice since 2013. So I've really gotten to know the Houston market. The Galleria is essentially a world famous market. It's renowned for its commerce, its retail, its entertainment. It's considered the third skyline of the Houston landscape. You have the main downtown, which has been there for decades. And then you have the medical center south of that, which is also a large area that is considered its own skyline. And then you have the Galleria. So Houston actually has three skylines, which is a testament to how big this area is. So as you can see here, it's the 15th largest business district in the US, has 30 million square feet of commercial space, tons of restaurants, tons of nightlife, tons of shopping, one of the biggest malls in the country. And the Ridley is literally in the heart of this. It's within 1 mile. And so this area, not only just Houston in general, but this area has seen a lot of population growth. Houston itself has seen a lot of population growth. Texas has seen a lot of in-migration from the coast, from California, from New York City. So the amount of upward macroeconomic pressure, both economically and population growth wise, is just huge here. And I think that really speaks to the strong fundamentals of this deal. The average household income is $92,000 and the average home value is $473,000. What this tells you is that we are going to be moving to a renter nation. The price of homes are going high and the supply is low. And another key point about supply and demand is that during the pandemic and shortly after, when the interest rates were raised, it became very difficult for developers to build new, not only houses, but new apartment buildings. So there have been zero starts in 2022 to 2023, and that's going to actually take its effect over the next 12 to 18 months. There's going to be a drop in supply of apartment buildings in markets like Houston. And this is going to have a huge upward pressure on existing properties like this in very dense areas where there's not a lot of space, but there are a lot of people moving who can't afford homes and they have to rent. So all these macroeconomic like check marks I just checked them off when I evaluated this deal, and that's one of the big reasons why I love it. So now let's talk about the investment overview itself. These are the numbers, what you can expect as an LP. Like Bio said, we're getting it at $66K a door. This is below the submarket comps, which he'll show later. We're getting the good financing. What does this all mean? This all means that when you invest, you're going to get a good return. And that's cash flowing from day one. We're talking 7 to 9% average cash on cash that we expect regardless of if we start making more improvements. It's as is. We're getting it at such a low price, at such good debt terms, that it will cash flow from day one. The fact that we have this low risk business plan, we don't need to go in and start, renovating everything. The previous group did a lot of that work already and sold it to us at a discount. And so the underwriting is very conservative. It doesn't include huge rent increases. It doesn't include all these big boosts in property valuation. It's actually very conservative, and still it's going to yield a 20 to 25% average annualized return. That means you're doubling or more your money in 5 years. So again, it's located in a great area. So this is high level executive summary. The Ridley is in the Galleria. It's in a very dense, popular area of Houston. It's extremely low cost basis. You're going to see that a lot in this talk, re-emphasizing the cash on cash return. It's in an optimal location. We have a low risk business plan, 63% loan to value, all the things that you've heard before. And these are some of the pictures of kind of the quality. This is a 1971 build, but heavily renovated to really bring up the aesthetic. I drove this property. I've been in this area, Galleria, many times, but I specifically drove this property in the daytime and at night. I felt extremely safe walking around. I looked at all the other apartment buildings. There's about 10 to 15 other apartment buildings literally in that area. It's like apartment building central. And the Ridley stands out because you can see the work that was done on it. They repainted it, they added accents, they cleaned up the pool. There's still more work to be done, but most of the work has been done for us already, which is huge. The property's 405 units, as said before, built in 1971. There's multiple buildings, multiple areas for parking. This slide is a little not formatted right. So there's 14 buildings, not one building. They're 2 stories each. It's 90% occupied. The average rent, which is below market, is just about $1,000, and the average unit size is 750. You can take a look at this on your own. It's a mix of 2 bedrooms and 1 bedrooms, 2-in-1s, 1-in-1s, which is standard for that area. These are highly desirable for workforce housing. These are the people who work at all these retail and white collar jobs in that area. And here are some of the examples of the upgrades made by the previous team. Okay, and so there's about 200 units that have been upgraded like this. So there's a lot of room to go ahead and do this. Again, we don't have to, but we can continue along with this type of value add where we change the laminate floors, we add paint, we spruce up the brightness, we add all the appliances to just bring out, and this is light value add, this is not a heavy value add because we don't need to do a heavy lift for this property to perform well. It is already performing well. So these are some of the unit features. Again, over 200 units, or excuse me, almost 200 units have already been renovated, so 169. That leaves 236 for us to renovate if we want to. Okay, and it's not a must, but it's if we want to. We can go in and add some more cabinets, the stainless steel appliances, the flooring, the carpeting, all the lighting fixtures, just to bring out the aesthetic and the curb appeal.
And I'm like to add, oftentimes you already have about 40% renovated. I'm not sure what the percentage is on top of my head. What you really need to do is just do maybe another 20% towards the end. So you can say, oh, there's more meat on the bone also for the next buyer. So right. It's a great strategy to basically just cruise along, do a little bit of test it out. If the market can sustain premium, right? Renovate few of them, get the premium. Or like, oh, look at that, we renovated 5, it's full. Let's do another 5. So there's no rush. So to this kind of renovation.
I'll kick it to you for the business plan. So some more of the numbers, Bio.
Okay, yeah. We talk about the occupancy already. So the occupancy is actually close to the submarket occupancy. So it's already 90% stabilized, like we said. Same thing with already talk about the 4 million in capital improvement. And the main thing is the team, they're really bad in operations, and also the loan didn't work out for them. Goal is to improve operational efficiency. And we know this will be done because Disrupt Equity have an in-house management team that is managing most of their portfolio, including the one that George was involved in. So they already know the market, they understand it. So that's, to me, also decrease the risk. Actually, an investor asked me, would you, in this climate, would you do a deal where you don't have a partner or boot on the ground? And the answer is no. Right now, this is not the time for necessary risk. So you want to make sure that you double down, right, with the boot on the ground. And so someone was also asking if we're going to do more. So we learn from the past, right? If you don't have enough reserve or enough money to at least weather the storm in case. So there's 3 million, which we basically overraise. We have that for deferred maintenance, just if. And also, we can use that money to renovate also later. If it wasn't used for deferred maintenance, then we can use it to renovate more properties. Like we said, it's basically bringing in the new management team, which is in-house. We can see every single cent, that goes in and goes out. And then we are going to have like meetings every week, and we talk about it. And I personally feel better with the vertical integration, because when you have outside property management, sometimes you get all these miscellaneous costs that you don't even know why. Why is this happening? Yeah, the business plan is simple. I like it for that reason. Any deal that it takes someone too long to explain to me, that we have to first of all do this, then we have to then do that, and then we need to flip this and that. I'm like, look, this is for the next 2 years. I just want a straightforward deal. This is one of those. And same thing, this is still the renovation that has been done before. You can see the pop in the sign, the pool, and also look at the new kitchen appliances, refurbished countertop. So it's, yeah, and look at the play area. It looks beautiful, like a classic Class B. And some of it is actually almost like A in terms of the amenities.
Yeah, they really put a lot into the common spaces with that $4 million worth of upgrades. So you walk in and you feel like you're in a new build.
Yep. So you got the fitness center, and also with dog park. It's actually pretty cool in terms of when I go to Class B. Oftentimes in the Class B, I think about it as just a safe place where I want to live, but I was not expecting to have a clubhouse. So this have a little bit of added benefit. And Class B don't have to have a pool either. You don't have to have a pool. So I think this is going to be a very good community where the residents can all hang out and foster more kind of community kind of environment.
A little bit more about the market overview. You can take a look at this slide. It's clearly showing, it's busy, but it shows all the industry and economic activity that's happening around this area. A lot of employers, a lot of stable work that's going to be around, and not just workforce, it's white collar work, business district as well. So take your time and go through there. If you're in Houston, you probably already know Galleria Mall is literally 5 minutes away. Houston ranks top in many different categories. So you can take a look at this slide. I think it'll show you many different, categories that it leads in, but what we just know on a 30,000 foot level view is that there's just a lot of both economic and population growth in Texas and in Houston and all the sister cities in that economic triangle. So Austin, Dallas, San Antonio is just a massive upswing. The number I'm familiar with, I know there's a lot of numbers here. Number I'm familiar with is that there's 60,000 people moving to Texas daily. It's just staggering. So for the year. I think that's just staggering. And so we're going to see the effect of that over time for sure. It's going to be upward pressure on things that are in demand, housing, medical. And so this is no different, right? More on the submarket demographics, 2.4% population growth in that submarket, 115K average household income, whereas the average 3-mile radius home is 733K. So just literally across the highway from where this gallery is River Oaks. So you're talking very expensive area, limited supply, even though it's high white collar as well as workforce housing. This bodes well for upward pressure on rents. 64% renter occupied households. That number is probably going to increase just based on the limited supply. So it's ideally situated in other growth submarkets. So you're probably 10 minutes away from the Med Center. You're 10 to 15 minutes away from the main downtown, the original downtown. You have the Energy Corridor, which is 10 minutes west of this area. So that it's really centrally located in not just its own strong economic neighborhood, but all the other economic industries and neighborhoods that are in Houston. Same thing, just mentioning the different districts. Again, TMC is there. There's a central business district. There's Energy Corridor. There's all the growing suburb markets that are starting to emerge. They get a lot of commuters that come into Houston. So there's just a lot of economic activity in this area. And Bio will talk about some of the comps, more numbers.
Yeah, it's pretty explanatory in terms of what you want to do is look for like as identical as possible properties in the area, and then you want to look at what are the rents. So that's how they do the comps. You can see some of this also from the appraisal, but it's better to actually do it yourself. So this was done by the team because you can get as close as possible. As you can see, for the one bedroom, the Ridley is much lower. The lowest one in this area was 945, and that's still over $145 above what the Ridley is getting right now. And so with the market, the premium is close to $300. And then for the two bedroom, I like to see that also over $200 in margin. Some data was coming out last year, in terms of like class A, and some of B pluses are having to, lower, maybe not lower rent, but they have to give incentives to get it rented. So which is essentially lowering the rent. So, but in this case, you have so much margin that I feel like even if you're still the lowest among them, we're still going to be profitable. And that is not considering that some of this, about 40% is already premium. And then we can do a little bit more if we get a lot of cash flow and the business plan allows. And that should be going to all the way to the top, right? Because it's going to be the most renovated, right, in that area at that time, the premium. So yeah, looking good. And then this is the sales comparable. It was tough to find a lot of transaction because we all know the transactions slowed down a lot in 2023, and especially in the 2024 started to pick up. But the latest one that was sold which is next door to Ridley. So it sold at over 100,000 per unit. So that gives us a lot of hope, right? That if we're going to be able to achieve, that would be insane, but it's going to be very great profit for us. And this is not even underwritten to sell exactly at that price. And look at the year, go back one. This is actually 1962. As you can see, the age is also similar. So this is an old district. There's the 1977 was the latest one in that area. So we're not far off.
Very dense.
Yeah, we're not far off at all.
All right, so some investment details we talked about. 8% is the preferred return. So that means the team is obligated by law to return 8% of that first 8% has to come to the investors, whether that's cash flow or from capital gains. It's a 5-year projected hold. The minimum is a $75K investment. And for our non-accredited investor, we are in 506B right now. We are actually closing the 506B tomorrow evening at 5 p.m. Central Standard Time. And that's strategic because we want to take a week and then start our 506C. If you don't know what those mean, it just means how we can market the deal. Right now, we are only presenting this to our close colleagues, friends, and family. And then in about a week or two, we'll start broadcasting publicly on different channels, and that will only be for accredited investors. So if you're a non-accredited investor, and we can talk about what that means if you're not aware, we do have a very short runway for investing into this deal. There's only 35 spots made available for a non-accredited investor on a 506B. Just as I mentioned before, here are some details, just the investment summary. Another thing to note here is how it's structured. That 8% preferred return is a very simple split. After that, anything profit-wise is going to go 70 to the LPs, the limited partners, 30% to the GPs. There's no further waterfall or fancy split after that. It's just a straight industry standard of 70-30. So the majority of it obviously goes to our capital partners who are our LPs.
Yeah, I like it.
Distributions are paid monthly, and I can attest to this as I'm in the Derby at Steeplechase with Disrupt Equity, And it's one of the first deals that I've ever seen monthly distributions. And so we believe we can start this at 3 to 6 months. On Derby, they started at 6 months. This one's even better. It's cash flowing from day one. We may even be able to start at 3 months. So distributions paid monthly. And of course, a cost segregation will be done, which Bio will talk about a little bit later. So just an example, just to make it tangible, think about say $1 million investment or $100,000 investment if you take off one decimal point. If you invest year one, you can expect a 4.59% return, cash on cash. That means you're getting distributed $45,000, almost $46,000. If that was $100,000 of investment, that would be a $4,600 distribution paid out monthly, meaning you divide that by 12. Every year from that, it goes up until that averages out to just under 8% cash on cash return. So you can see as the deal progresses, as the property starts to increase from those macroeconomic effects we've been talking about for the last hour, you're going to see the cash flows go up, and the average cash on cash return is 8%. And so, yeah, your average, that will equal an average annual return of about 25%. You're doubling, more than doubling your money over a 5-year span. This is just a nice, easy example of what those numbers actually mean on paper. There's a sensitivity analysis involved as well. This means we stress the deal to see how it would perform, even if it wasn't at 90%, or if we didn't get the industry standard of rent increases, which is about between 2 and 3%. And I can tell you, you can see this is disrupt equities stress. Bio and I actually took the spreadsheet and we stressed it even more. We stressed the vacancy all the way down to 20% like they did, but on top of that, we stressed it to 0% rent growth for the first 2 years, and then only 3% rent growth from year 3 to sell, year 5. And it's still cash flowed. Yes, the IRR and the average annual return slightly decreased, but it still was making cash flows that were considerable and making it still an attractive investment, even in an extreme situation where you have low vacancy and extremely low vacancy and extremely low rent growth. And so I think this is really a strong testament to the fundamentals of the deal.
Yeah, you don't see this a lot anymore, especially in the big market like this. But yeah, the stress test for me, from all the other experiences, we learn, we grow, and every single deal, you've been involved in over 25 deals, right? And I've been involved in actually close to that, but many of them are my own properties. And then we learn to do the stress. We even stress it to the level like, okay, what is the maximum stress level to just get out with your money? So it's a lot of runway.
Yep, very
Good
important.
margin.
Yep.
Yeah.
So here's where all the money is going to be going. We're raising, like Bio said, about $3 million in CapEx. A lot of that is just actually going to go to the exterior light value add. We're going to increase some of the amenities, curb appeal, like the dog park. There's some things we can add. We can add pergolas to the pools for shade. We can add more grills so residents are not buying their own grills and putting it outside and cluttering up the common.
Yeah, you don't want that grill.
Fire risk as well. Ask us about fire risk with Southbrook. All right.
Yeah, don't even talk about it.
Yeah, you'll see we'll add 1.3 million just to those exterior amenities plus another 210,000. 1.5 million just going to these exterior light value add. Nothing heavy because 4 million has already been put into those amenities already. And then optional, again, can't harp on this enough. One of the other big check boxes, we could still go in and upgrade those additional 239 units or some number of them, 20% of them. And that's optional if the market shows us that it'll support that. And if we do, we will allocate $1 million to that upgrade, some of those pictures that we showed earlier. And then we'll always keep cash ready on hand. This is a 1971 property, so we're ready if anything roofing wise, foundation wise. We have the reserves to go after these capital expenditures, and we'll have contingencies for that reason. So we're really happy how capitalized we are for this deal. Bio.
So Yes, I know. We do bullets acceleration, accelerated depreciation for every single deal. And even despite the fact that every year since Trump left office, how many percentage that you can depreciate has decreased, we still believe that we're going to be able to get about 40 to 60%. Let's just put in the middle, right? So if you invest 100K, hoping based on the analysis that we'll be able to get at least 50K in your first year. So usually we accelerate depreciate it first 5 years, but you get the majority of it in your first year. But then you continue to get depreciation every year also. And so it's if you're like a real estate professional, this will be a great one for you to use against your W2. And like we talked about yesterday, even if you're a passive investor, hopefully you've been investing with us. We've got some few investors here that can testify. So they exited some deals already. And then you have this profit. You can use this depreciation against that one. So the more you invest over time, the more you can just be using this asset depreciation on one against the profit of the other one as you go. So either way, it's it's a plus.
And of course, disclaimer again, always consult with your tax strategist or legal professional.
Absolutely.
We are medical professionals as well as syndicator, real asset syndicators. So please consult with the appropriate professionals.
So someone was asking about the fee structure early on. So we're still going to take the questions, but most of it will have been answered by now. We already talked about the 70-30 split. I find that to be the perfect split in general. You do 90-10 or 80-20, then there's not enough meat on the bone for the GP to put their energy and effort. You do too much, 50-50, then people start feeling cheated. So 70-30 has just been that where we believe so. Even in our coaching course, we teach our mentees those. Another thing is the management, the fees. We had come up with that number, which is different for everyone, of that 5% in general. If so, you between the acquisition fee, capital transaction fee, and the asset management fee. So you have about 4, 2, 2, and 1. You can rearrange it. There are some that will take less acquisition fees, 1, but then they take 2% capital transaction fee. But I think the range for acquisition fees between 1, which we actually do not advise, to 3.5. So 2 is just right there in the middle. Same thing with asset management, between 1 to 3. So we'll pick 2, and a capital transaction fee, depending on how much the others were. So I think this is fair, personally. Another exciting thing is the management fee. Despite the fact that they have an in-house property management team, so they are only charging 3%. And this talks about the economic of scale of multifamily, large multifamily. And that's why sometimes I wonder about some of my 8 units, if I should just sell them, right? Because I'm paying 9% to my property manager. Whereas we got this deal like this, 3%, right? So that's margin enough. It's already about 6%, enough to cash flow, right? Enough cash flow to distribute. So anyway, so that's just the testament of kind of the fee structure. And it's very transparent. You can see it, you can ask for it, you can ask for the documents. We're very transparent in general. And if our partner is not transparent, we're not going to be involved in the deal. And this is about the property management. You can talk about it since you've been involved with them.
Yep, I've been on their calls for the Derby deal in Jersey Village. They actually brought this team on. They became in-house on my first deal with them in San Antonio. It was struggling with a third-party property management team, and they went through about 2 or 3 of them before they just decided to scrap all of that and bring it in-house. And since then, like I said, 20% average annual return on that deal. So they really salvaged it in a strong, booming market. And they're performing well on all their other properties. I sit in on these calls weekly. I hear about the other properties in addition to the Derby. I'll sit on the calls again for the Ridley. They not only do their own properties, disrupt equities deals, but they even help other syndicators and do other properties. So they have good track record in Houston, as you can see by the map here. Sponsored track record again, there's just an idea of what they've done over the last 7 to 8 years. Alamo Oaks at the right is the deal I was in. That was my second deal ever as a LP. Very happy with the returns, and you can see their performance record is very similar, if not better. I wish I was in some of those other deals, as you can see by their returns. Of course, past performance is never indicative of future performance, but we do like the trend. So the next steps in the process are to just review all these offerings. We have a link that we will post on the chat for you to access the video, the PPM, which is the legal document. You should have your legal team review as well as you review and ask us any questions related to that. Then it would be e-signing on that portal, and of course funding. Like we said, it says April 30th, but we will go with 506B till tomorrow. We'll extend it till 5 p.m. tomorrow Central. And then for the 506C, we'll extend into June, that first week of June 10th. Same time, 5 p.m. Central is when we'll stop accepting accredited investors. And then we shake hands and we watch this deal perform. We execute. And so that's the investment process. Here's just some criteria. We are accepting retirement funding as well. And so that is on the table. 1031 exchange is accepted as well. This is a first come, first fund, meaning even if you put your legal signed documents in, if we fill up before you actually fund, then we do have to close and we have to have you wait for the next investment opportunity, which will be another deal. So it's first funded, not just first to come and to fill out the forms. So again, I'll leave this up. This is just the process. If you're ready to commit, we can have that conversation and get you onto the portal and get signed, verified, and then funded. We'll send this out to everyone. There will be frequently asked questions that you can review. I know some of them have been coming in through the chat, but we want to make it interactive as well. So we're going to go through that and allow folks to even come off mic and ask their questions. We'll leave this slide up while we do that, but we can always go back and review any other slides that you guys may want. So I'll kick it to Bayo to start our questions.
So I really love the deal. I think you check out all the check marks. And so we have our email. You can actually leave the email.
I'm going to leave it up. Yeah, I'm going to leave it up.
Yeah, so you can email either of us and say, oh, hey, if you need more information, we'll give it to you. If you've never talked to us before for 506B, you have to at least have a little bit of conversation with us and also establish some relationship to be able to invest. Otherwise, you can wait for the C. In that case, you can just be anywhere in the world and just invest. So let's go for the questions. The first one I have is, where do we find the fee structure for the project? Also, are the GP invested in the project? So the fee structure we already talked about, it's going to be 70-30. It's preferred return, which means even in, let's say, in a situation where no distribution happened for 5 years, when we sell, you first of all have to pay all those 8% for the past 5 years before the 70-30 split. So which means the investor will always get that 8% average return. So that's just something to align investors' goal with our goal. Also, in terms of the GP invested in the deal, we are invested in the deal.
Absolutely.
So we are in every single deal. If we're not, in fact, we have not done some deals. Like I just started my private practice, and I actually did, in all honesty, did not bring any deal. And no matter how exciting it was, because I didn't actually have the money to put in the cash flow. So we do. And also not just us, Disrupt Equity. And we also have Tariq. He's actually bringing the check.
Yep, Disrupt Equity, they wanted this 506B period. So a lot of the team members in their company can invest as well. So they're bringing about $3 million invested into this deal just from the Disrupt Equity team side. I'm absolutely putting money in this deal. I like it. It checks so many boxes for me. So I'm investing on the LP side as well. So I'll be writing a check to this deal. 75K is coming from my side into this deal. So skin in the game is absolutely important. I would say be very wary if operators, sponsor team is not putting money on the LP side. So they're already putting money on the GP side. They had to get this deal off the ground, get it sourced, get it underwritten. There's a lot of earnest money, so that's one side of it. But they also need to be putting money on the LP side, taking the same risk that you're taking as an LP. And so I'm proud to stand by that and invest alongside with everyone on the LP side.
So another one said, what is the year of construction of the asset? So we showed it 1971.
Yep.
And looking at the type of asset in that area, it's well in line. And also there's a lot of capex that has been done. Right. We still know that because it's that old, it's going to have some deferred maintenance, and that's why we're very capitalized.
I would definitely harp on that. It's a very good question. These older properties, you want to have some kind of mitigation. And I think that $3 million raised, not borrowed, we're raising that. So we have access to it whenever we want, if there's any deferred maintenance that comes up. So great question. The follow-up is, how is that being mitigated if it's an older property? And that's our way of mitigating it. So great question.
Yeah. Any future capital cost? We kind of talk about it.
Yeah, same question. Yep.
Yeah. What is it? Sorry. I think this may have been answered, but any construction on the property. So no real, construction in terms of you think we're going to break something to the stud and build it back up. We're not doing that. So it's going to be light value add. So maybe basically optional. Painting, painting, maybe some carpeting. So basically just landlord special. Let's push it up a little bit.
All right.
And to confirm, I think you said 25 years. I'm not sure where we mentioned that.
What was the question?
You said 25 years old. So yeah, it's 1971.
That's a little more than 25, but
more than that, yeah.
42, 43 years.
And then how is the overraised amount already known, considering there are still funds coming from non-accredited investors? And later, the investment will be opened up to accredited investors. So this is already done in the underwriting. So, I guess the only time that question might matter is if you don't end up raising all of it.
Right.
But I have no doubt, based on the team. I mean, we have Tariq, right? You guys know him. We have Disrupt Equity. You have me. You have George. We have 2 other team members. Never say never. But if we all of us cannot raise the 15 million, then we probably should find another profession. So yeah, the underwriting is based on the fact that we're going to be able to raise all the money, right? And then we're going to have that 3K, because we could have raised 12, but then the deal will be very shaky. And from prior experience, when you borrow from banks can basically hold the funds, and sometimes they might have different requirements for you to get the funds out. But if you raise it in your bank and keep it, yes, it will lower your return, because if we don't raise that, your return might actually be like 10% cash on cash and 30% average annual return. But it's better to take a little bit more conservative approach, raise more for the safety of the project. And so that's what it is. So it's from the underwriting. It's not, so that's how we know. So what else? Did you see any more? Any flood? Hold on, sorry. Will this slide be emailed? I'm not sure how people opt in. Did they opt in through email? If you're in our investment group, so if you're not, you can go on my website or George's website and register as an investment in the investment club, and you'll be able to get all of our emails. And if you are registered for any of our webinar before, you're going to be part of our email list. So we're going to be able to email it to everyone.
Yep.
Or you can just email us.
Yep.
Just type in this email and email us, I want a copy or something. So also, once it's 506C, we'll be able to post it on our website, actually, the actual deal. I can just click and go for it. But for 506B, you have to talk to us. Okay. What else? We're also going to post it. We already posted it on our WhatsApp group, which is the easiest way we communicate. What else? You can also read it to the judge because
Okay.
I'm having trouble scrolling.
I see how many GPs are there. So there are 6. So 2 from Disrupt, 2 Bio and I, and then Sherry Chen and Tariq El Musa.
You can consider George and I to be one, to be honest.
Yep, just like Disrupt Equity is 1. So there's 4 teams here. So we purposely keep it small. We don't want those big teams with too many GPs and co-GPs. That was very popular over the last few years. And I think those are ones to really just, I don't want to say stay away from, just look at them closely. Be very cautious with those. And yes, they're all personally invested. Everyone's going to have skin in the game. This is, again, huge thing for me. I vet this like ridiculously. It just doesn't make sense. It's not as attractive to me if you're not invested. It clearly doesn't show alignment. Any flood risks? There are no flood risks. So we checked 2 different sources to make sure this area was not in a flood zone. And that's a very good question for Houston. There's had been a history of flooding, and this area is not in the flood zone. We checked Harris County Records website. Property
Someone
tax.
also said something about why didn't the old tenant, I guess they meant the seller, sell it for 100K because of the, if your deal is struggling, you can't show 2 years or like at least a year of good T12. It's tough for you to get market value, number one. And if people can sense that you're in distress, of course, they're not going to pay that value. So what happened is that the REIT already took it over, right? Judge was
The REIT took it over. They saved it. So like we said, the business of the operations is fine. But they are selling into a high interest rate economy, a high interest rate landscape where you literally have to devalue, like by nature, you have to devalue. It's NOI over your cap rate gives you your value, and cap rates just went up. You can't stop that. If the Fed raises interest rates, cap rates will expand. So everyone took a haircut. Everyone got devalued, no matter who. If you bought in the last 2 years, it's not like cap rates expanded for some and not for others. Cap rates expanded across the table. And so maybe there's small little submarkets, very small submarkets where the demand was so high that cap rates went down, but everyone's properties were devalued. So we've been waiting for this. Like in the multifamily industry, people have been waiting for the sellers who have the rear view mirror to like finally capitulate. So they tried to sell for that amount, but 2 buyers couldn't make the deal work at those high interest rates. They had to either raise more capital or they had to walk away, which is what they did. And so in order to sell this deal, the sellers had to come down. And that's what's going to happen a lot in this industry or in this current climate. But that's a really good question about if this deal is so great, why is it so discounted? It's literally the numbers.
Yeah. And then, so what's happening right now is most deals, if many of them can weather the storm for the next 2 years, they're probably going to be okay. So the question is, can you? So that's the question. That's what's going to happen this year versus maybe early next year. Is some will be so close to be like, if you can just weather the storm 6 more months, you make it. But many will capitulate before that. It's just a cycle.
And this is a group that's not interested in multifamily as part of their main book of business. So it's better for them to take this loss. It's like a blip on their overall assets under management, which is more office and retail and other markets and sectors. So they're willing to capitulate. They're managing it from Canada, and so they're willing to take the loss on it after 2 failed sale attempts.
I interrupted you on the property tax one. Do you want to
Okay,
take
yeah.
it back?
Property taxes have skyrocketed. Yes, they have. They've hit Texas hard. That is looking to slow down now. But yes, it could keep going. There's no crystal ball. But there's even legislation out there to actually get a rein on the skyrocketing taxes. I think it's mitigated by the low purchase price. We're buying it at such a discounted price, and it's actually written into the pro forma. It's written at this higher cost. Can it go up more? Yes, absolutely. But that buffer of this low purchase price is what makes this something that mitigates these expenses, right? Insurance is also high as well. But our debt service is very low purchase price, discounted at a low interest rate, sub 6, with interest only for the first 2 years. This is how we're mitigating.
Yeah.
This is how we're mitigating all the other expenses. And then the business plan involves going in and decreasing other expenses, right? Getting economies of scale, getting a good property management integrated team in there to lower expenses, increase revenue. This is the mitigation plan for the taxes.
Someone asked, are T12 and rent roll available if asked?
Absolutely.
Yeah, we're very transparent in general. So if you ask us for something, we'll send it to you. Okay. I know we're very respectful of your time. We just wanted to be sure that people understand the deal. So it's recorded. We can send it privately right now, but whenever we email it, please do not share it on social media or anywhere visible, okay? Because it's 506B still until we file for the C. And that's when we run the ads. We know from prior deals, like Overland Park, it filled up in 10 days. And we raised a similar amount of money because you run the ads, people call you randomly, or people just invest randomly. You wake up in the morning and you have $1 million commitment. So, yep. So if you want to get in, yeah, time is of the essence.
Awesome. Awesome. Thank you, everyone. We hope to be in touch soon. Thanks for your patience and going through this hour plus with us. We hope everyone has a great night, and we'll be in touch soon.
Good. Take care, everyone.
I have a question.
Yes.
Go ahead.
So if we use Plaid, do we know how quickly the money is transferred? If we use Plaid tomorrow, would that count as meeting the deadline?
I can inquire and see. I think it's as long as it looks like there's evidence you can show that the money has been initiated, the transfer wire has been initiated. I think it should be okay. That's what I was discussing with the team, the rest of the team today, because we were trying to make sure we know exactly how we're going to have that cutoff. But I'll double check with them and see if that's going to be okay. But I imagine so.
And that's why we also have that 1 week just to make sure everything hits. So you don't want that mixture of one 506B came in, done into 506C, and then the whole deal is invalidated. So it's very serious with the SEC.
Yeah.
Well, but then we'll let you know for sure.
Thank you, guys. You've been very helpful. Thank you.
Thank you.
You're welcome.
Okay. Take care, everyone.
All right. Bye, guys.
Bye.